Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Special purpose acquisition companies, SPACs, have become a hot topic in investing, offering a faster path for companies to go public. These blank check firms raise money first, then hunt for a private company to merge with. While SPACs can open doors to exciting opportunities, they also come with unique risks every investor should know. This video breaks down how SPACs work, why they're gaining traction, and what to watch for before putting your money in. Whether you're new to SPACs or looking to refine your strategy, we'll cover the key details to help you make informed decisions. What are special purpose acquisition companies, SPACs? SPACs are shell companies created to raise money through an IPO, then use those funds to buy or merge with a private company. Think of them as a shortcut to going public. They skip the traditional IPO process by acquiring an existing business instead. They're often called blank check companies because investors hand over cash before knowing which company the SPAC will target. For businesses, SPACs offer a faster, less paperwork-heavy route to becoming publicly traded. For investors, they're a chance to get in early on companies that might be hard to access otherwise. But like any investment, they come with risks. Uncertainty about the target company, time constraints, and reliance on the SPAC's leadership to make a smart deal. The structure of a SPAC. Every SPAC has a few key pieces that dictate how it operates. Sponsors. These are the people or firms behind the SPAC, usually experienced investors or industry insiders. They put up initial capital and led the search for a target company. Their reputation matters. Strong sponsors increase confidence in the deal. Trust account. IPO proceeds go into an interest-bearing trust account. This money can't be touched until the SPAC finds a target or dissolves. It acts as a safety net for investors. Common shares and warrants. Investors typically get units in the IPO, which split into common shares and warrants. Shares represent ownership, while warrants let you buy more stock at a fixed price later. If the SPAC succeeds, both can gain value. The structure is designed to protect investors while giving sponsors flexibility to negotiate a merger. The life cycle of a SPAC. SPACs follow a clear timeline, usually within 18 to 24 months. Here's how it unfolds. IPO. The SPAC goes public, raising money with no specific target in mind. Investors trust the sponsors to find a good deal. Target search. Sponsors start hunting for a private company to merge with. They might focus on a specific industry or keep options open. Deal or dissolve. If a target is found, shareholders vote on the merger. If approved, the private company goes public under the SPAC's ticker. If no deal happens in time, the SPAC liquidates and investors get their money back, plus interest. The clock is always ticking. If sponsors rush to beat the deadline, they might overpay or pick a weak target. If they wait too long, the SPAC could fold with nothing to show. That's why researching the team and timeline is critical before investing. Why invest in SPACs? SPACs attract investors because they bridge the gap between private startups and public markets. They offer exposure to companies that might otherwise stay out of reach, with the potential for early-stage gains. But what exactly makes them worth considering? Let's break it down. Access to pre-IPO companies. Most retail investors never get a shot at hot startups before they go public. By the time they hit traditional IPOs, the biggest gains have often already happened. SPACs change that. When you invest in a SPAC, you're buying into a pipeline for future mergers. The private companies they target could be high-growth disruptors in tech, biotech, or green energy, sectors where early investors often see the biggest wins. Some examples of SPAC successes include DraftKings. Merged with a SPAC in 2020, and its stock surged as online sports betting gained traction. Virgin Galactic went public via SPAC, giving everyday investors a chance to back space tourism early. Unlike traditional IPOs, where institutional investors get first dibs, SPACs level the playing field. You don't need insider connections, just a brokerage account. Potential for high returns. Not every SPAC delivers, but the ones that hit can outperform the market. Here's how. Pre-merger excitement. Speculation drives up share prices before a target is even announced. Savvy investors sometimes cash out early for quick gains. Post-merger growth. If the acquired company thrives, shares can climb significantly. Think of electric vehicle startups like Lucid Motors, which saw spikes after merging with a SPAC. Warrant upside. Many SPACs include warrants, which let you buy more shares at a fixed price. If the stock jumps, these can multiply returns. Of course, high potential comes with high risk. Some SPACs fizzle when hype fades or targets underdeliver. But for investors who pick wisely, focusing on strong sponsors and credible targets, the rewards can be substantial. Risks and challenges of SPAC investments. While SPACs offer unique opportunities, they also come with risks that can catch investors off guard. Unlike traditional IPOs, SPACs operate in a gray area where transparency isn't guaranteed and the rules are less defined. Some risks are structural, others depend on luck. Both can hurt your returns if you don't understand them up front. Dilution and warrants. Warrants might sound like free money, but they can quietly erode your ownership stake. Here's the problem. When warrants are exercised, new shares flood the market, diluting existing shareholders. For example, if a SPAC's warrants let investors buy additional shares at $10 and the stock climbs to $20, those warrants get cashed in fast. More shares mean yours become a smaller slice of the pie. But dilution doesn't stop there. SPAC sponsors often get 20% of the company's equity for a nominal fee, which further shrinks your stake. These promote shares, incentivize sponsors to close a deal, any deal, even if it isn't the best one for investors. The math is simple. More shares without added value equals weaker returns for you. Key points to watch. High warrant coverage, e.g. by 1 warrant per share, increases dilution risk. Sponsor promote shares often lock up for a set period, delaying their impact on the stock. Warrants can expire worthless if the stock doesn't hit the exercise price. Due diligence challenges. Investing in a SPAC is like buying a mystery box. Until a target is announced, you're betting on sponsors to pick a winner with little public information. Even after a merger is proposed, SPACs face lighter disclosure requirements than traditional IPOs. That means less financial history, fewer audits, and more reliance on forward-looking projections, many of which turn out to be overly optimistic. The rush to meet deadlines makes this worse. Sponsors have 18 to 24 months to find a target, and pressure can lead to sloppy deals. For example, some SPACs merge with companies that have unproven revenue models or shaky financials just to avoid liquidating. Retail investors often find these flaws too late after the hype has already inflated the stock price. That's a quick overview of how SPACs operate and why they've become so popular. But there's more you should know before making any investment moves. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.